Hi guys. Today we will analyze Colgate Palmolive stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, the long-term trend is neutral. Not much exciting going on here. Strong support levels are around $74.50 and $72.20. Next strong support levels are around $69 and $65. Strong resistance level is around $78.50. Next resistance levels are around $82 and $85. In the last month the stock has been trading between $73.90 and $82.30 range. It is currently trading near the lows of this range. The stock has an average volume of 6.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 3% per year, for last 5 years. We see that the average profit margin of the stock has been around 14% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 120% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Colgate Palmolive Company: bad, average, and good. First scenario. Colgate Palmolive will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 1%. Future profit margin would be low, 12%. Future free cash flow to net income rate would be low, 70%. In this case, the fair value of the stock today would be $48. Second scenario. Colgate Palmolive will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 2%. Future profit margin would be average, 13%. Future free cash flow to net income rate would be average, 80%. In this case, the fair value of the stock today would be $61. Third scenario. Colgate Palmolive will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 14%. Future free cash flow to net income rate would be high, 90%. In this case, the fair value of the stock today would be $76. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.41. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Colgate Palmolive, analysts forecast growth rate around 3% per year in next 5 years, and future P/E around 24. Again, I will use 3 different scenarios for Colgate Palmolive Company: bad, average, and good. First scenario. Colgate Palmolive will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 1%. Future P/E would be low, 20. In this case, the fair value of the stock today would be $22. Second scenario. Colgate Palmolive will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future PE would be average, 23. In this case, the fair value of the stock today would be $28. Third scenario. Colgate Palmolive will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 26. In this case, the fair value of the stock today would be $35. As you can see, today the stock is overvalued, $75, even if we expect the company's high performance in future. While Colgate has a good profitability rating, it has a high debt level. Also, the company is expected to show a very small growth in revenue, 3% per year in the next 5 years. Based on that, the stock looks overpriced at the moment. Colgate is a dividend king, so I may consider buying the stock for the dividend when the stock drops to $60-65. Company's strengths. Colgate Palmolive is an American multinational consumer products company. It specializes in the production, distribution and provision of household, health care, personal care and veterinary products. The company's products are sold in more than 200 countries. More than 70% of 2021 sales came from outside North America. Sales are split almost evenly between developed markets and emerging markets. Demand for household and personal care products will be relatively static, and not severely impacted by economic cycles, relative to other industries. The company is valued for its recession-resistant business model, reliable dividend, and strong balance sheet. Shareholders can benefit from the defensive nature of the stock. Colgate is a dividend king. The company has paid a dividend every year, since 1895, and has raised its dividend for impressive 60 consecutive years. The stock currently has 2.5% dividend yield. Colgate has a return on assets of 13% and profit margin of 12%. This is amongst the best returns in the industry. Risks. In the near term, the COVID-19 crisis and the residual inflation, labor and supply chain problems are the biggest challenge. The company could lose market share to lower-tier products, if consumers' budgets are stretched by inflation, or be unable to raise prices enough to offset costs and maintain margins. Management said that 2022 is shaping up to be a more difficult year than it anticipated, with greater than expected increases in raw materials. The company expects a 60% increase in its costs for fats and oils this year. Freight rates are also up from 30% to 100%. The biggest long-term risk to Colgate is a lack of sales growth. Toothpaste and cleaning supplies are mature categories in developed markets. The company won't be able to grow as more people recognize the value of brushing. That's already happened. Colgate will need to raise sales of its most innovative products, including premium toothpastes, products with natural ingredients and high-end pet food. Colgate competes with Procter & Gamble and with private label brands at Walmart, Kroger, Walgreens, Costco and others. In addition to large global operators, Colgate also goes up against smaller, niche startups that have proved more agile in responding to ever-evolving consumer trends. The company has a high debt level. Based on estimates for the next 5 years, Colgate will show a very small growth in revenue. The revenue will grow by 3% on average per year. The earnings per share is expected to grow by 6 to 8% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.